And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to The Real Investment Show. It's the Hump Day edition, right? It's the second best day of the week, right? Third best. Tomorrow will be second best. Friday's the best day of the week, of course, as always. We're going to get there.
Who's counting?
Who's counting for the weekend already? When's our next holiday coming up? That's what we need to be doing.
Monday.
I know, right? Already got a holiday coming up right around the corner. Seems like we just got through with holidays.
We needed a holiday to get over our holidays.
This is actually a point. That's true. So anyway, a couple of things this morning. Now, we're going to get into this more tomorrow with Michael Leibowitz when he gets here as well, because he's our resident Fed expert. But yesterday, Jerome Powell, up on Capitol Hill, basically giving testimony now. Now remember that Jerome Powell recently reappointed to his post as Fed chairman by Joe Biden. So he's now, serving another term as Fed chairman. Yesterday, giving testimony, said some very interesting things. And there's some things that we need to be thinking about now as we move further into this year. First of all, he said that economic growth is very strong and the economic recovery is doing very well. Now, in order to prolong that economic recovery, we've got current levels of high inflation that was caused by the supply chain shutdown, and these inflationary pressures are now starting to potentially weigh on that economic recovery that we're having. So with regards to that, he feels, and he and the rest of the Fed members feel, they need to more aggressively raise interest rates and tighten their balance sheet. Okay, now, if we were in a normal organic recovery that was occurring, I would absolutely agree with his sentiment. And that if inflation was a function of really strong economic growth that was organic in nature, I would agree with the statement that we need to be much more aggressive about hiking monetary policy. But what he seems to forget, and really when this comes down to a lot of mainstream economists, right? If you listen to the television media, read a lot of articles, they're talking about how great the economic recovery is, yet we all forget, or at least seem to forget, that this economic recovery was a function of $5 trillion worth of fiscal liquidity, and mind you, debt-funded fiscal liquidity provided by the government into the economy, right? We sent $1,400 checks to households, $900 checks to households, $1,400 checks to households, extended unemployment benefits, child care tax credits, you name it. We were flooding households with liquidity. So what did they do with that money? Of course, they went out and they spent it. Well, the economy was shut down. So of course you had supply chain disruptions because you couldn't produce enough inventory to meet the pull forward demand of all this liquidity pumped into the economy. So we've pulled forward a lot of that liquidity. All that liquidity was used to pull forward demand. So in other words, people were out buying stuff that they wouldn't have bought in 2020 or 2021 because they didn't have the capital. All of a sudden they have it and they go, woohoo, can't travel. Let's go buy a new washing machine, dryer, whatever it was, and go buy a new car. So we pulled forward all that demand. Now, the problem, the problem for the Fed is that they're thinking that the economic recovery and the supply chain disruptions are a function of a strong organic economic recovery, yet it was really the function of all this liquidity, which now is retrenching out of the system because we haven't passed any more bills. The Build Back Better bill, which was going to extend the child tax credit, that seems to be, at least at this moment, dead in the water. Doesn't seem to be any more fiscal liquidity bills coming down the pike, even though Nancy Pelosi recently saying now is the time to do another one. We need to do another one. Americans need more money in their pockets. Well, of course they do. You're about to go up for re-election, so you certainly want to give everybody a chicken in the pot, right? So this is the problem, is that we don't have any more of this fiscal liquidity coming into the market. So what consumers had, they spent, and now this inflation created by that pull forward demand is eating into, it's eroding their ability to maintain their cost of living because the inflation's running higher than wage growth. Businesses are now struggling with higher wages. That's going to begin impacting their profit margins. Now, when wages rise to the point that it impedes the profit margins for businesses, what do? They can either pass on that inflation to a point to consumers, their customers, or they begin trying to minimize costs within their business structure to maintain profit margins. What does that mean? Well, that means we stop hiring people and we start laying them off. This becomes a deflationary spiral in wages ultimately as that occurs, and that starts to push the economy towards a recession. Here's the problem for the Fed. The whole premise of their belief is that this is an organic recovery. It wasn't a temporary illusion of recovery created by $5 trillion worth of stimulus that is now gone. So now the Fed's going to be hiking rates and pushing tighter monetary policy onto an economy at the time that liquidity is leaving the system. So you're going to start having a retrenchment of this economic growth, a reduction in inflation as we get further into this year, as demand begins to wane on the system. We've already seen inventories come up. We're already starting to see a lot of the supply chain disruptions starting to fade here. And this is because demand is already starting to slow. Disposable personal income, savings rates, those are all returning now back to previous trend growth that we saw prior to all this pandemic-driven liquidity. So the Fed has now potentially put themselves into a very, very tight position. The risk going into this year is that they make a monetary policy mistake. And again, we'll talk more about this with Michael Leibowitz tomorrow, the ramifications of this. But these are the things you really want to start focusing on now. It's not something that's going to happen immediately, but this is going to start changing the dynamic of the market as we get further into this year. And as we talked about earlier, one of the things that we expect this year more than anything else is probably a much more volatility. So again, you're going to start to see more drawdowns of 2, 3, 4, 5, 10%. You'll see a more common occurrence of those potentially this year. Don't know for sure, but that would be reasonable to expect in an environment where you're beginning to hike rates. Again, you're going to see a lot of initial commentary say initial rate hikes by the Fed don't matter. They don't. It's to the point that they hike rates that all of a sudden something breaks within the markets. Now think about everything that is debt driven in the economy right now. People have been out buying houses like crazy over the last couple of years. Why? Because we gave them a down payment. Interest rates were low. We gave them money to go buy a house. They went and bought a house. The problem is now is they've got to maintain it. Now, as interest rates start to go up, what happens to the refinance market? Well, people stop refinancing their mortgage. I'm not going to refinance my mortgage at a higher rate. That makes no sense. And I'm not going to buy a house at a higher rate because if I'm a consumer looking to buy a house, as rates go up, prices of homes come down. So all these people that bought overpriced houses, they're now going to be underwater, unable to sell their house. And people looking to buy a house are going to do two things. One, they're going to say, well, prices are coming down. I think I'll wait to see if prices come down a little bit more. That's deflation. And that's the psychological response to deflation, is to wait to see if prices go lower. The second thing they're going to do is say, well, I'm not going to buy a house with rates here. I'm going to wait to see if rates come back down again. Why? Because rates always come back down again. This is going to start to feed, that whole psychology feeds through the economy. And this is where you wind up with that inverted yield curve ultimately. That would probably be something later this year, late 2022, start to see that inversion of the yield curve. That'll start setting up the premise for a recession. And that's all assuming the Fed maintains their current tack. My suspicion is that as soon as this all starts to occur, the Fed backs off. But we'll see how this plays out over the next couple of weeks. We'll talk more about this with Michael Leibowitz tomorrow. But Danny Ratliff joining me here after the break to talk about, does asset allocations at one size fits all? Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Don't let 2022 be a repeat of the past year. Join Danny Ratliff and Richard Rosso for their essential smart money tips for the new year Candid Coffee event on Saturday, January 15th. You'll learn the landmines to avoid, tax advantages we see, and money tips you need to know in the new year. Register now for our next Candid Coffee at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
I'm fired up this morning. Too much caffeine already. Already had 2 sips. I'm ready to roll. That's what I get for drinking Deathwish this early in the morning.
Oh, man. Brent got you on that too, huh?
Oh, yeah. I think Brent switched on me, though. I think he went over to Black Rifle. But see, I'm giving up on Black Rifle Coffee Company. I enjoyed them when they were a private company, but they sold out to private equity now. So now they've gone to the dark side. So I think I'm going to have to find me a new, small, and up-and-coming brand of coffee.